This episode of CFO Thought Leader is made possible by Planful and Avalara. This episode's made possible by Planful. Hello, on today's episode of Planning Aces, we'll be featuring FP&A insights and commentary of three finance leaders, including CFO Cyrus Lamb of Orion Innovation, CFO Joanne Cheng of Jellyfish, and CFO Zach Johnson of Cribl. This is Jack Sweeney, your co-host, along with performance management guru Brett Knowles, who will serve as our resident thought leader as we seek to highlight the takeaways from our distinguished group of Planning Aces. We'll begin after this. Ready to plan confidently, close faster, and report more accurately? Here's what sets Planful apart. Imagine purpose-built applications for every department, from FP&A to accounting, marketing to HR, all with built-in financial intelligence. It's easy to implement Planful in just weeks and with minimal IT involvement, so you can rapidly and seamlessly engage everyone across the business on your key financial progress. Best of all, Planful grows with you. Its unparalleled scalability ensures that no matter how fast your business expands, Planful can keep up. See why over 1,500 customers worldwide choose Planful as their flexible, user-friendly, end-to-end financial performance management platform. Go to planful.com/CFO Thought Leader to see how you can reach peak financial performance with Planful. Welcome to Planning Aces. I'm here with Brett Knowles, of course, and we'll be spotlighting the FP&A best practices and strategies of three finance leaders, as usual. The episode will highlight how our three Planning Aces are partnering with sales, operations, and beyond, and aligning everything from, pricing models to resource allocation, so that their companies thrive and not just survive, I suppose. So, Brett, as always, we'll turn to you for some ironclad perspective. We're hoping you'll help us diagnose what's sort of the big story here behind the three CFO experiences we're about to hear. But up front, what do you see? What did you find?
I think we're in for an interesting lesson. The theme today to me is you can either look at it as, ensuring the connection between the different functions. But what's more interesting to me is the common theme about sales, market generation, go to market. And that's always in any business, the secret sauce to success. And it's kind of fun hearing some planning aces actually talk about it and how they've grappled with managing that sales cycle. So I think it's going to be an interesting listen.
Okay, well, we'll kick off then with our first planning ace, who will be Cyrus Lamb, CFO of Orion Innovation. CFO Lamb draws upon a career spanning decades in investment banking and corporate finance. The story he shares is pretty compelling. It's about how he went about resolving a misalignment in sales incentives, and how a more collaborative effort, was able to double profit margins. Here's what CFO Cyrus Lamb shared with us.
I'll just use a straight example or a story as you sort of described it. In my previous job, one of the hot buttons was really, how do we pay people on their on commissions, right? Commissions can be one of those things where if you don't structure compensation right, it can drive the wrong behavior, and B, it can not be a fair sort of exchange of value between the company and the person, company and the people. And so one of the things that we found was there was a disconnect between the way in which our salespeople were paid for some of the services revenue that they were generating, not in our current business, in one of the prior companies that I worked with. And there was also a disconnect between how the delivery people were paid. So all the salespeople cared about was, hey, I got to get top line. If I get top line, I get paid, so I'm good. And all the delivery people cared about was, I want to put as many people as possible on this job so my utilization metrics look good and everything else looks good, right? So there was this disconnect where the salesperson would be like, hey, I'm going to try and get some more revenue, but the delivery guy is trying to load as much cost as possible. So what happens in the middle, once I've paid commissions to everyone, it could be that we might have, loss-making projects that have not been well thought out. So we thought about that as a team, and we're like, okay, what's the ideal, right? The ideal is what we want to give people is the ability to earn the same amount of money or more, but we want them to give us something. So we told the sales guys, listen, we're going to get you metrics around everything, and you're going to be able to trust them because we're going to publish them. It's going to be transparent, and we want you guys to be involved in this. But what we want you to do is go and sell as much revenue, but sell it at the right profit margin. Like sell it with the right people, consult with delivery, make sure that delivery buys into what you're selling and price it correctly. And then if you have pricing leverage with your client, go get a little more. If you can do that and you get to the target margin, we'll give you more, a little bit more than what you were getting before. But if you can get a higher margin, we'll share more with you. No problem. But if you get it at a lower margin, we're going to take money away from you. So it wasn't just all give. It was like, hey, you guys, we're all adults. They're all pretty smart guys. You know how to sell. Go sell well. Go consult with your delivery teams and make sure that you're not just selling stuff and giving things away. And we told the delivery folks, we want you to think about this as your business. If you were running a one-man shop, not literally, but if you were running a one-man shop, how would you use your resources? How many projects would you take on? How much time would you spend on each one? And think about those metrics. And then we had the systems built already that allowed everyone to see the data completely transparently. So there was full trust in what we were providing them from a finance team perspective, which was absolutely critical, because imagine if I put all these things in and then the data just wasn't there, or the data did not make sense. There would be a lack of trust. There would be a complete breakdown in how the businesses were aligned. And so finance was completely transformative in that moment. And I wouldn't say it was just finance. It was finance and operations, delivery, the sales team, the sales leadership, our CEO and the COO, all of us working together to put these plans together. And what happened, the net result, right? So you'd be like, so what? What's the big deal with that? What happened is when I joined the business, our margins on one part of our business were roughly 20%. And by the time we sold the business last year, they were double that. So significant increase in overall GP in that business line. And by the way, this was with us paying more commissions than we would have paid, because we got salespeople aligned well. And every year we would pay more to the delivery folks as well. So it just took away all sorts of issues from the business about, hey man, inflation's up. I need to get my eggs and I need 3% more. It's like, no, you got 15% more on your bonus last year because you did so well. Keep doing that. Now, if you want to take on more responsibility and you want to move up in life and you want to get a promotion and you want to, so let's have that conversation. So that was a clear transformative or strategic moment for me that finance plays a role in the future of the business way more than we think it does. And if we're not participating in that, we're just along for the ride, and that is not good.
Now, I should mention Cyrus joined us on episode 1053, and he shares his career journey. And I thought he did a great job of explaining how some of his past experiences came forward and helped him address or tackle the misalignment. Anyway, it sort of comes full circle in the episode. But Brett, what did you make of all of what Cyrus covered here?
Well, it's an interesting conversation. What we've learned over the years is the closer you are to the customer, the easier it is to measure performance. So obviously sales is at the blunt end of this thing. And so there's always a whole bunch of data that's required and available. what he talks about, and he uses the term the fair exchange. And I think that's a great term to use. The compensation system we find in most organizations is not linked to the strategy. What's that look like? Let's say you've got a new product launch, and what you're really trying to do is get new customers to try this new product. You're not really worried about revenue in the first quarter or first half year. I'm just worried about people using this new platform. Then I'll worry about revenue later. So what does that look like? It looks like for the first couple of quarters, I'm not worried about the sales dollars and compensating for the sales dollars. I really am worried about getting new names or getting penetration in your account. The dilemma is if the compensation model is all based on revenue, or more importantly, my quarter end report to the board is looking for that revenue number. What ends up happening is the salesperson, instead of getting that new platform implemented, goes for whatever's going to drive most revenue that quarter, because that's what the compensation says. That's what, the investors want. So, the strategy says we're going to get the platform implemented in, 100 sites. They're actually still going for revenue. And so now we have that disconnect between what the strategy calls for and in likely the long-term success of the business and the short-term. The example I always think of is, think back when the iPad first came out. So you're working in an Apple store. I can sell a desktop computer, easy peasy lemon squeezy, because everyone gets it. iPad, on the other hand, looks like a big iPhone with no applications. And so, but we know that's, the long-term future of the company. That's that discrepancy between getting the platform out there and getting sales revenue. Obviously, getting iPads out there is better for the long-term viability of Apple. But that quarter, if they're compensated revenue, that's not where the salespeople
And I guess,
spend their time.
misalignments are very common because as companies evolve, there's a chance that things become misaligned every month, every week. So what he was sharing, I think, can be widely appreciated.
Well, and it could be just because I'm a bad listener, but I went through the recording a couple of times. He talks about how by adjusting the sales compensation system, he moved it from, and of course, if you remember his stories about how sales is driving revenue, but the support people are adding cost because they're trying to improve the revenue line for their department, which is against corporate strategy. I mean, that's that example of the strategy disconnect. So he moves the profitability from 20% up to 40% by the compensation structure. But I'm not sure I've heard or understood how we reconcile the tension between the sales force wanting to get revenue dollars and the support team or installation team, implementation team needing to get dollars allocated to them for the implementation work that they're doing. Did you catch how we reconcile those two things? Okay. Wasn't my listening skills. So, the issue is somehow or the other that was done. And, for your listeners, that's the same issue. How is it we have what appears to be conflicting objectives of different departments, get them aligned towards that overall North Star, in this case, profitability. And it is all a cost allocation game. In other words, there's no accounting regulation that says I need to allocate money to the support team, or I need to deduct that from the sales commission, or, economic cost per unit, whatever it might be. So we make up these rules for ourselves, and then they become self-constraining. They drive the wrong decisions. No different than my earlier example of commissions versus wanting to get the platform out there. Here I've got two departments that are both with targets that in concept individually are the right decision, but in conjunction with each other are driving the wrong direction.
It seemed to me that a misalignment would be less common inside SaaS organizations today, just given how they have this visibility. They enjoy greater visibility, different metrics. Would you agree with that thesis? It's not too bold, I don't think.
Well, I would expand that a bit to say that our accounting systems are clearly significantly outdated. Again, accounting systems were set up in the agricultural era when I'm translating tangible assets to tangible assets. So I'm changing fields into crops, crops into sheep, sheep into wool, wool into sweaters. tangible assets. And that's how our accounting systems are set up with things like depreciation. When we get into the knowledge creating era, which we are in now, more value comes from, sharing knowledge than from sharing tangible assets. The accounting systems fall apart. So things like this, your podcast is free. That doesn't mean it doesn't add any value. Merely the accounting system cannot see the value this adds. So, our journey has always been about how is it we truly take a look at the value that an organization's creating. Google's a great example, right? When they did their IPO, they didn't have 1 single cent of revenue, but everyone who bought stock understood there should be a relationship between eyeballs, the amount of time people are using the Google tools, and the ability to generate revenue through advertising and so on. Now, clearly we've seen that was the case, but at a moment in time, it showed the discrepancy between the accounting system and how businesses should really be valued. And that's a gap often between book value and the actual value of the asset. So, coming back to the conversation here is the accounting systems have failed us for a long time, but we could fake it. With SaaS companies, the gap got so huge that we couldn't fake it anymore. We had to come up with new accounting structures, new ratios, new formulas like, ARR that didn't exist before in order to more accurately capture the value stream associated with the business. So my argument is yes, and they better accommodate SaaS companies, but also other companies as well. So things like, an economic unit or the rule of 40s, we didn't worry about before. They sort of emerged to the SaaS world because of the huge amount of intangible assets involved. Now they're going back into blue chip companies as better ways to take a look at the accounting structures. Still don't map what's really going on, but at least we close the gap for a while.
Well, we'll tee up our next planning ace then, who will be Joanne Cheng, CFO of Jellyfish. Now, Joanne has built her career inside several startups. And when she joined Jellyfish as its CFO, she is really the architect and the builder of the finance function there, right from the ground up. So she comes with a great amount of perspective. This is Joanne Cheng.
Definitely. I think the CFO sits in a really unique and special spot where they have visibility on everything going on. And so sometimes I'm the connector. I'm like, hey, someone is talking about this over here, and I'm hearing another department or group leader talking about the same thing. And I'm like, you two need to talk together because I'm talking to both of you and I am hearing some similar themes and so you are a connector. And you also see what everything is being spent on and what people want to spend money on. So you also have visibility and data into that, and all the people that they want to hire and what they want to hire them for. So all of those things, you are a connector across the company team. The company was very small. It was 90 people, and there was no finance team. So I was the first finance person, which is usually not the case. You usually wouldn't hire a CFO before you hire, an accountant or somebody. So I built up the whole team here. And it's, I actually really loved having that all being able to choose everyone we hired and form the team. I added a couple people to FP&A, and the next thing is a mix of technology and controls and understanding of what is going on. So every model is being built, like all the drivers of the business, kind of the relationships on, how does someone get hired? How do you buy something? How, like the revenue model, like, how does revenue come in? How do you get a booking? And all of those processes need to be established and set up. So we added FP&A, we added a couple accounting folks, and then we also added biz ops and rev ops kind of. So all of that has been formed, and then we put in some systems, but it's not just systems, because you need the process behind that as well. RevOps reports into me, and it's basically, I think of it as, how does a sale get from the beginning of the sale to where we get the cash in the bank, and that is reports under me. But it's a really good partnership, because like they work probably even more time with the sales team and the marketing team and the account management team than they work with finance, but we work in collaboration with each other.
I love how Joanne illustrates how the finance leadership is really about being the connector or the unifier, where finance integrates with sales, marketing, and ops. She really underscores it nicely. What did you make, Brett, of what Joanne shared with us?
I thought it was interesting on a couple levels. One is, she talked about how when she first joined the company, it was 90 people. We see this transition that happens sometime between, I'm going to say 50 people and 150. So 99's in the sweet spot there, where the entrepreneur can no longer put their arm around the business. And all of a sudden they need ways to better explain, extend their strategy, but also share the load. So her comment about, wasn't it unusual for them to hire a CFO at this point? That's an example of sharing the load. Obviously, the entrepreneur used to do that, or the entrepreneur's husband or wife, whoever, did the accounting structures. Now we're going to offload that to a professional. So she saw it to be unusual, but I think that's a pretty common footprint that we see one way or the other. It could be I'm hiring a professional salesperson, a professional marketing person, a professional accounting, but at that point, suddenly things break. The other thing is, at 99 people, you often bump into everyone at the coffee pot in the morning, back in the good old days when you go in the office. And you kind of knew everyone. And I often describe that transition point as when the entrepreneur is walking down the hallway, someone's coming the opposite direction that you don't recognize. You didn't hire them. You don't know their wife, their kids, their dog. And suddenly you realize that you're out of control. And so that's, a symptom that you would see or feel as you're in that transition moment. So that whole idea of CFO being a connector is that logical extension. Now that it's beyond what the entrepreneur can put their arms around, how do I connect it? Well, there's only 3 departments that talk to everyone: HR, IT, and finance. So one of those has to be the connector in every company, or it doesn't work out. Or the CEO is still doing that connection stuff that they were, doing before. So again, that's a logical extension from how the business has grown. CFO as a connector makes a bunch of sense. And even her story that she moved towards, which is, taking a look at how does sales, move, right from the sale all the way through the cash, right? So the order to cash cycle goes across multiple departments, and often it's a white space in between them. White space is a term coined by Roller and Brace, which talks about the handoff between department to department. And that's often where things fall apart, right? The example there is, your passport takes 2 weeks to get them to you, but they only spend about 2 hours. Everything else is going from one department to the next department as it goes through the validation, printing, distribution process. Anyways, so the idea of the CFO being the connector, and the idea of taking a look at a value stream, order to cash, as one process or one cycle across all the departments is a great way to uncover both the waste, the discrepancy as a handoff, but also the discontinuity. In the example that Cyrus had, that discontinuity showed up between sales looking for revenue and the implementation team looking for implementation hours to make their department look good. So if you look at it as one system, not a series of departments, you begin to understand and see those discrepancies. And as a connector, you try to iron those bizarre decisions out. And I'm pausing there because what we're trying to do is optimize that process. And so I'm going to set up the best equation for sales, a different equation for implementation, a different equation for product development, and they don't work homogeneously across the system. So again, Joanne's a good example of how our FP&A processes evolve and what you'll see as they grow and what you should do to help combat them.
Well, before I tee up the next planning ace, let me just mention that Joanne Cheng's episode was episode number 1055 on CFO Thought Leader. Again, she has a really interesting early chapters that allowed her to get inside some of these cutting edge companies. Our next planning ace is Zach Johnson, CFO of Cribl, and wonderful mentoring round with Zach, who shared some insights about his career building. But here he shared something very unique, I thought, and I'll just tee it up. It'll speak for itself. Here is Zach Johnson, CFO of Cribl.
Yeah, so I kind of I really look at the business in kind of three key areas, and I kind of really drive the company accordingly, which is I call them my 3 Ps, which is precision, predictability, and performance. And when I say precision, it means we continue to close more accurately, faster, while also being able to deliver a clean audit. Predictability, reducing the margin between what we deliver and what we expect, right? So that means continuing to work with go-to-market teams on pipeline, capacity planning, and making, measurable impacts to the business and that are repeatable. And then performance, continuing to execute over an extended period of time at a high level. And so I really focus on creating durable and sustainable growth in the company. And I also think it's the role of the finance leader to help the business understand what financial shape the business must be in to optimize shareholder value. So when I look at public companies in the software space and the ones that have the characteristics that generally align with higher valuations, we are looking at metrics, things like Rule of 40, Rule of 50, and that helps us and helps me kind of shape the conversation with us internally and make sure that we're driving towards the right direction. And, as a company that's high growth and we continue to grow at a high pace, every year we make improvements to the business to make sure that we're creating the right levers, measuring those levers, and creating to drive to those outcomes we want and getting a more efficient every year. Actually, it's kind of a funny story there. So I've always kind of talked about this kind of unit economics concept, and then also bringing together the metrics, but also helping the business understand that their role and how they participate in it. And so, just to go a little deeper there, we have what's called our manager summit here, and shout out to Lisa Nielsen, our people leader here at Cribl. She puts together this event where she brings all the managers at the company, and it's an opportunity to educate them, help them in terms of developing skills to be great managers, which will ultimately benefit the employees culturally, but also from a productivity standpoint as well. And I was given the opportunity, there was a little apprehension, but to talk about metrics to this group. As they are leaders in the company, I felt it was important that they understand, how do the metrics work and why are they important? And in that discussion, we went through, CAC LTV, Rule of 40, what is free cash flow margin, and how do all those things play together? And, I kept using this kind of like, this is what investors care about. This is what investors care about. And at the end of as I'm kind of, halfway through this conversation, I'm like, I keep saying investors, and you're probably like, it's this third entity that's off to the side. That's this foreign thing. But then I asked everybody, hey, raise your hand if you have equity in this company. And of course, everybody in the room raised their hand. And I said, guess what? You care about metrics too, because you're an investor as well. And so really articulating for them how the levers work. So for example, not to pick on our go-to-market folks, but, reps are always like, hey, let me get an SE, or let me get another channel person, or let me get this, and helping them understand like, cool, I can invest in this SE for you, but that might mean your quota goes up. So how do you want to, let's work together to find the right balance and lever where we're getting the right outcome for the business, but we're in this together. Like, I'm building something from the tops down that's going to be the right shape financially for the business, but I need you from the bottoms up in correlation with my team to figure out what are the right levers that are going to drive us to that outcome in the most efficient way and in the most repeatable way. And so helping everybody understand that, I think the one that I will say from the audience participation, the rule of 40 was the one that I think people are not as familiar with as I had assumed, but we've been educating folks. I've actually kind of gone on the road with this presentation. We have a development center in Poland, actually. I actually went to Poland and presented on this too. And the level of interest, once people kind of start understanding how it kind of works and the nuances of, well, the rule of 40 is revenue growth plus cash margin, and that's the one we use. And so understanding the balance there, but also how it reflects in the market, where, you know, growth is still a bigger driver in that equation, and so we can't lose focus on the overall growth strategy as well. So
Okay, well, it was great to have Zach Johnson with us on the show. I love how he talked about how he educates employees on how the metrics impact their own equity and the company's trajectory together. Thought that was really insightful.
We're always competing for mind share. And I bet you if you talk to most people in the organization, they would get his 3 Ps. Because they make sense. It's easy to remember. Most of your work fits into one of those categories. And it's a good filter. Like if what I'm doing doesn't fit one of those 3 Ps, why am I doing it? So, I like that. And that thinking of his, as you said, got repeated throughout his conversation, that ability to, weave it together. His comments about durable and sustainable growth, clearly he didn't make up those words. Like, they figured out that they want durable, which is an interesting word I don't hear often, but works. Sustainable, we hear all the time. But when you've got the durable component with it, it just adds that extra dimension. I also like the way he moved into what, we used to call open book management, Jack Stock's idea of just teach people how to think about accounting and what it looks like. And his, as you say, rule of 40, rule of 50, his unit economics, those are all good foundational building blocks to train every employee on, no matter where they are. He had an advantage, the story of helping people understand that they're actually the investor that he's trying to please. Even if you don't physically have an investment in the company, you're still invested in it. In other words, if you don't do your job and the company fails, you don't have a job. So it might not be a stock you're getting back, it's just your paycheck, but we're all invested in the companies that we work in. And we should understand, these core metrics that guide management decision. So I like just how he packaged it and how he understood a good portion of his responsibility was communications. He gave us the example of his go-to-market people where they're asking to hire new people. And he said, great, if you understand the different ratios and numbers we talked about, go ahead and hire people, but that means I'm going to give you a higher quota. Which in some case, we listen and go, well, duh, of course that's the case. But obviously it was an aha moment for that team where he wouldn't have brought it up as a story for us. And he described it as the top-down, bottom-up. And I've heard that term tons of times, of course, but that was a great example of that top-down, bottom-up, right? Where bottom-up, I'd love to have more people to help me do the sales, not understanding necessarily that there's a relationship between that and the quota thing. Top-down, I'm worried about the profitability and don't look at hiring people. So I think it was just a fun example with our theme of the go-to-market, understanding how the communication is important, and the understanding of the business mechanics, which we think might be intuitive, is also important.
And I once more get to ask you to identify your takeaways from these 3 planning aces. What would those be?
So again, what I said at the beginning was there's 2 things. One is a theme about making sure that we look across departments to see the stream of value that's created. I often think of, checking into a hotel. You could have everything perfect. You get to the hotel, check-in's fast, you go to your room, it's gorgeous, it's nice and warm, it's brilliant. You've, got a nice bed, the TV's all set up with your name on it and so on. And you hop in the shower and there's only cold water. Doesn't matter how good all those other departments, housekeeping was, reception desk, everything else, the whole value chain, the whole business falls apart when one department doesn't do its bit. In this case, the water heating department. So seeing across departments is super important. And there are very few departments that do that, finance being one. So that's one common theme. The other part is getting a handle on that go-to-market team, making sure that the guidelines that we're giving them are consistent with the strategy to get the outcomes that we're looking for. So those are the two simple messages I pick up.
Now, are you spending the holidays up Canada way, up north there, or?
No, just, till we get the turkey sacrificed and then we head back to the warm Florida sunshine for a chunk of time. That's what us snowbirds do.
Well, we look forward to speaking to you then after you return down south. For Brett Knowles, this is Jack Sweeney at Planning Aces, wishing you a very happy new year, everyone. As always, Brett and I thank you for listening. Hello, everyone. Jack here. Hope you've been enjoying our recent episodes of CFO Thought Leader. Please know that I don't take for granted this opportunity to serve you. Your time is valuable, and of course, so is the time of our CFO guests. I'll admit to you on certain weeks, I will pinch myself and say, hey, I get to do this for a living. I speak to all these impressive leaders. Undoubtedly, there are more aggressive interviewers out there, some who leave no stone unturned. But our swim lane is for finance leaders only. And those finance leaders have a unique style of leadership, one that is rooted in the burden of trust. In light of this, finance leaders must take great care not to forfeit this trust as they step into the role of being a more expressive leader. And that is what CFO Thought Leader is really about. That's why I try to remind myself week in, week out, how fortunate I am. Still, I need your help. Tell us what we're doing right. Tell us what we're doing wrong. Email me your comments at jack@cfothoughtleader.com. And please visit cfothoughtleader.com. You'll find a listener survey right on the nav bar. As always, thank you for listening.